Welcome to Innovation Leadership. I'm Jess Larson. On this episode, we get to have Emmy Sobieski. She comes out of investment banking and the hedge fund world and is a best-selling author. We're going to hear about her Mega Wealth series. She's an ultra-marathoner. She's extremely accomplished in dressage. Emmy, thanks for doing this.
Thank you so much for having me, Jess.
So I first got interested, I think, with Mega Wealth careers and this idea of like jobs that can help you make $100 million, which is not the typical value prop for a book about jobs. Can we start there and then tell us about the whole series? And then I really want to dig into all your background.
Yeah, absolutely. So that was the first book that I wrote, and then I've rewritten a second edition of that. And so the idea is that if you pick the right careers, certain careers, and these were mostly the ones that I'm familiar with, but any career that has a particular type of leverage that is natural to that career is a career where you can make a lot of money. So that can be anything that is 0 to 1, effective, 0 to 1, 0 to 100, that like you're the one person and you're talking to 100 people, you're talking to 100 million people. You're managing a fund that can manage $100 or 100 million or 100 billion. You are a CEO and you have 10 employees or you have 10,000 employees. That is kind of leverage. And so it can be Taylor Swift. She can sing to 10 people. She can sing to 60,000 people. She can release an album for millions of people. And my mother was a screenwriter, so she had that kind of leverage. But what I focus on in the Mega Wealth Careers book is also the careers that I'm really familiar with, so that I can tell specific stories about venture capital, private equity, board of director roles, and then founder and C-suite roles. And those are the areas that I focus on, mostly because they have the leverage and I'm super familiar with it. As I was talking to people about these careers, the same patterns kept coming up over and over. Well, okay, so I know the career, but when should I break in? When do I start building equity? How long does it take to break in? What if I don't like it? Some of those questions I answered in the careers book, but some of it is like, well, what is the framework that I need to be thinking about? So maybe I want to do this in entertainment, or I want to do this in real estate. I want to do this in something where Emmy's not as familiar. You can still use those same principles. And so I wrote a kind of a umbrella book called Mega Wealth that covers those general principles, which is what I call the money flywheel. And then the 3 B's of breaking in, building equity, and breaking out. And those combined really shows you how to take those careers and turn it into mega wealth.
Okay.
The final...
Yeah, I was going to ask, and tell us about the third book as well.
Yeah, so then the final thing that happened is I'm working with clients. They're jumping into these new careers, are super excited. They're working with interesting people. And I'm saying, look, your career is the biggest investment you're ever going to make, because you cannot get your time back. You can, and yet people will pick a new job or a new career because some CEO really gets them excited or makes them feel good or compliments them, or they get a 5 or 10% raise and they jump over to this new thing and invest a bunch of their time. And if they're taking equity, they haven't analyzed whether they think that equity is going to go up. They do it in a tertiary thing, like, they're excited about the company, they join. And you have to think about every career move you make, that your time, it's like you're investing it in the most important investment that you've ever made in your life. And what I found was that the clients that I work with, I would say, well, just analyze it. And it's like, well, that's fine coming from someone like me who's been an equity analyst for 30 years. Of course, I know how to analyze a company and pick the ones I think are going to be winners. But my clients don't. And so that book ended up being 400 pages because it started out with all of the different frauds that I've seen over my career. And it's kind of an interesting twist on it. At least I thought it was interesting, which is why I wrote it. Which is that you can tie back all of the greatest frauds of all time to the 7 deadly sins. And either those managers were a victim of one of those 7 deadly sins, like greed, sloth, envy, or the people that are investing are also victims of those same sins because they have FOMO, right? They have greed, they have envy. And so you can avoid those frauds, and you can also spot them just by asking yourself, is anyone falling victim to these 7 deadly sins? Then I go into the basics of investing, and then I go into much more advanced psychological pieces of investing, such as like, if a company beats numbers, why does the stock go down? You will never have to ask that question again after reading my book. You will understand that, there's second derivatives, and there's different psychological ways that these hedge funds look at it, and they often are the marginal buyer. And the third piece of the book is, now you have the brain of a top institutional investor. You know how to do this. Now apply it to your career and apply it to private markets investing. And I have an additional filter for private markets investing because it's so illiquid. And so those are my three books, and they're very recently out, and I'm super excited that they've been well received and are already helping people.
Yeah, no kidding. And by the way, tell people, just like as a quick side tangent, tell people what dressage is if they don't know, and how far up you went in that.
Yeah, so dressage is the French word for training. And before we had tanks, we rode horses to war. And if you can imagine, a sad thing would happen in a war, your horse gets shot. Now you get on someone else's horse, and it's been trained. Like, if you think about how people train dogs, it's very random. You get on this horse and left is right, or he doesn't know what direction because he's been trained differently. That's going to cost you your life, because you're going to be thinking, okay, this cue means he's going to go left, and he goes right. And so dressage was kind of a systematized way to train all the horses the same, so that it's the same thing. Like, you get in a car, you turn the wheel, all the cars do the same thing. So this makes horses like that. And then it became a competitive sport after horses stopped being used in battle. So that was what I did for many, many years. Now I actually jump horses over obstacles, so it's a different sport. But I did that, and was 9th in the U.S. World Cup trials in 2005, and I was also globally ranked in dressage among professionals while I was managing $6 billion for Oppenheimer funds.
Wow. When you think about, and let's actually just talk about the investment banking and the investment fund management world. How much do you think that you have managed altogether between all the portfolios, if you added them up? At different...
more than 10 billion.
Yeah.
Yeah, more than 10 billion. Yeah.
Yeah. I know you've got so many takeaways, but what's one or two of your top takeaways from, having responsibility for that much capital?
So the biggest thing that people ask me is, wow, that's so much stress. How do you handle that much pressure? And I tell them it's exactly the same as riding in the World Cup finals for dressage. If you have a system and you develop a system over time and you trust that system, there's absolutely no pressure.
Yeah.
There's just no pressure. But there are times where you really get tested. Like, do you really have a system, or were you just using it for convenience? And so I'll tell you a quick story about that time. I was working at really one of the top hedge funds in the world at the time. And the guy there, he's very secretive. We never had a website, etc. And he said, the reason I hired you is to get semiconductors right. And I had basically sold at the top, bought at the bottom on every single cycle up until then. And so he's like, that's why I hired you. He hired me in November 99. And, we did some small trades here and there, but I was kind of treading water because I knew why he hired me. And the stock market was going bonkers, as you know, at the end of 99 and continued to do so into 2000. And in February of 2000, I went to Taiwan and learned that 80% of the chips that needed to be made for that year were already in inventory. So like, why do we need the factories? It was a very frightening statistic. And yet the things that I looked for in my system were not appearing yet. The things that I would look for to sell were not appearing yet, because that was not one of the things that I looked for to sell. That was not one of the things that determined the stock price, even though it determined the fundamentals. The next thing that happened was bookings started to roll over. So that looked like demand was weakening. And so the stocks came down about 30%. And my boss said, is this the time? Is this the time? And I said, no, the things that fit in my system haven't hit yet. In fact, we can buy here. And he's like, you got to be crazy. And I kept pushing and pushing and pushing. And he ended up buying, I think, because he just was like, I want to have her stop calling me. And the middle of June, I was like on an investor trip where you go on a bus trip, and then you go visit companies. We're going through Texas on a kind of luxury bus and meeting with management teams. And then you work at night in the computer in your hotel room, hunched over. It's like, it's not very glamorous. And, but you're responsible for a lot of money. And the fund at the time had, basically it was a 3 billion, we were long short. So we had 3 billion long, 3 billion short. And in semiconductors, we had 1 billion long, 1 billion short, basically at the time. So we were a true hedge fund. We were hedged, the same amount long as short. And the night when we drove around on the bus, then I went to work at night, and I'm checking all the numbers, checking the things that fit in my system. And normally if 2 of the 5 or 3 of the 5 hit, that means we hit a top, you got to sell. 5 of the 5 hit in a 36-hour period. And so I get up the next, and I had been on the phone call with we have our morning call with the hedge fund, and I would just like, oh, maybe we'll buy a little of this or a little bit of that, very like like a mouse for the first 9 months I was working there. And I came in and I was like, I don't care if you hold one single semiconductor stock, I don't care what the quality is, it's going down 80%. You got to sell them all, you got to short them all, like we got to get out. And now is the time. I've never seen this in my entire life. All 5 hit. And the entire group of the hedge fund, they're dead quiet. They're like, what is this mouse? Where did she come from? Now she's just lying. And so I hung up the phone, and I went to get on our bus trip, and my friend was the investment banker who's running the bus trip, and she was like, oh, how was your evening? And I said, oh, I bet my career this morning. She's like, oh, that's nice. Get on the bus. and then the other 2 analysts called me separately, screaming, saying, you're going to ruin this entire firm. You're totally wrong. You're crazy. They stayed long. And that trade ended up making my boss more than $100 million personally, just that one trade. And all of those stocks went down 80% on average, which gave us a 5x return for the short. So
that's incredible. Just quickly, what were the 5 things?
So they were, and they change over time, but it's not a peak in bookings. It's a peak in book to bill. And then it was actually like at TSMC, which is Taiwan Semiconductor Manufacturing. It was not their high end, but their low end wafer starts peaking. And then I also would look for some kind of, I know these are very random things, but I would look for each cycle, there would be some commodity piece that is like an on-off switch in semiconductor land or something like that, right? That literally should sell for less than a penny. And you would watch that some kind of random commodity piece would quadruple in price and would just be, and then there's like 2 other things like that. But there were basically 5 of those items. Those were always my top 3, but then there was kind of 2 other things, and they're all signaling, just like that the speculative bit is in the horse's mouth and the horse is running away, that nobody cares. So you're looking for things like that, where in that moment you have to ask yourself, who is the marginal buyer? If everybody's in, then the next thing that's going to happen is we start going down. And so, so that's basically what we look for. And then it worked out really well, because one of the things that's hard with shorting is you've got to borrow shares in order to sell them. So if everyone wants to short, you can't borrow the shares, or they're very expensive to borrow. Well, I can tell you, when the market's going up 2% a day, nobody wants to short. So we are getting like terrific deals in terms of our borrow rate, what the percent, our lending rate, all of this kind of stuff. It was like so easy to move $2 billion. Like it didn't even move the stock prices, because everyone thought we were so wrong.
That's so wild. Do you know Howard Marks' book, Mastering the Market Cycle? I mean, there's just so many things that you're saying that the two of you are so aligned on. And, when he's quoting Warren Buffett about the less scrutiny that everyone else conducts their choices, the more scrutiny we should conduct ours. Like you said, if they're willing to pay quadruple for something that should be, kind of a regular price, these kind of signs of excess. And that's fascinating. You listen to Howard Marks talking about his career, and like at times like that, betting big, right? And he's kind of saying, like, complaining to his son of like, why doesn't everybody do this? And they're like, and his son said something like, Dad, you've only done this like 4 times. Like, you've had a career for like 50 years and you did that 4 times, and that made your whole career. Who else can be patient that long? Like, this is not a common trait. And you did a lot of studying and a lot of watching, and to build the confidence to know when those times were. But it wasn't a lot of high activity, Dad. This isn't what you went and you didn't go and do that every day. And Howard was just, reflecting on that it's almost like, I don't know if you feel like there's any comparison, but my dad used to say, tell this story about the high school principal, and the Coke machine was broken. So he called the Coke machine repairman to come over, and the guy looks at it, shakes it, hits the side with a hammer, puts $1 in, Coke comes out, puts another $1 in, Coke comes out, and takes a invoice and writes it out for $100 and hands it to the principal. And the guy's like, $100? All you did was hit the Coke machine with a hammer. And he's like, oh, sorry, I wrote that down wrong. Rewrites it. Hitting Coke machine with hammer, $1. Knowing where to hit Coke machine with with hammer, $99.
Yeah.
I don't know if you see any analogy there, but
yeah, no, absolutely. Well, and the other thing is what Howard Marks is saying too is like, well, why doesn't everybody do this, right? And the show Billions,
yeah,
right? It's based off Stevie Cohen, right, of SAC Capital, and I interviewed with him one time, and the thing people wanted to hire me for was semiconductors, right? Because that's like, it was very hard to call, and I called it consistently. And I did the software. I've done a lot of other things, but that's the thing people wanted to hire me for. And so I was in there interviewing, and he asked what my system was, just like you. And he asked, like, well, what are the signs you look for? And he said to me, that could totally be computerized, right? Like, that can't work every time, because like, it's so simple. And you gave me the formula, but that's the thing. And that's where I was saying, like, when you really know you have a system is when you hit these really crazy times in the market, and you trust your system instead of getting wrapped up in the 7 deadly sins and your emotions and everything like that. And that's what I said, because so many people would say to me, oh my God, the next time that you see a low in semis or a high in semis, you let me know and I'll trade with you. And do you know how many times they traded with me? Over all the years? Zero. Because when they were at the lows, they're like, oh, things look so terrible, there's no way. And when they're at the highs, they're like, these are going to keep going up, don't worry. And that was the thing that even a multi-billionaire like Stevie Cohen missed. Because even if you computerize it, somebody's going to pull the computer. I have another friend that actually built this incredible AI system that actually predicted the emergence of ISIS 3 months before it existed, and predicted all of these, like, It predicted when oil went from $140 to $30 in a 3-month period. It predicted all of these port strikes. It was incredible. And what she had set it out to do was to model big shifts in society. So it was only looking for the, third standard deviation. It wasn't looking for the small stuff. And even they built that AI and they did not bet one penny on the change in the price in oil. So even if you put it in AI or you put it in the computer, your emotions are gonna take over if you don't if you haven't used your system and tested your system and tried your system. Your emotions are gonna take over and you're gonna pull the plug right before you're gonna make that money.
Wow, that's so fascinating. Can you give us just one more principle from from managing $6 billion at Oppenheimer?
So the other piece, aside from finding the highs and finding the lows, is every dog has its day. And I know that's a strange thing because I write in my book, I really believe in momentum investing. I totally believe in that. But there are so many times where a company is a second mover or a company is almost dead and then they have a revival. Apple had a tremendous revival from bankruptcy to one of the largest companies in the world. But there are so many companies where I have made quadruple on my money or quintuple on my money where there's a certain, just institutional drag where they're still alive and they can come out with one more product or one more thing. And so don't, obviously if something looks like it's going bankrupt, don't invest right before it goes bankrupt. But many of these companies that get ignored, and I don't mean to sound like a value investor because I think that's a lot of work versus being a momentum investor, but it is just something that I've seen time and time again. There was a company called Avid Technology, and they were a real high flyer back in 1995. I inherited this portfolio from this other tech analyst. He had a little bit of it left, and it had just gone down 80-something%. So my job is well, what do we do with this thing? Do we sell it? Do we give up? So I go to their main conference, which is called National Association of Broadcasters in Las Vegas. And I just talk through everything with them, what's happening. And they weren't collecting their receivables within 6 months, especially in Asia. They weren't getting money in. And there was a whole bunch of other technology changes, So by the time I had the end of that meeting, it was okay, all of the problems they have a good solution for and they're on it and they're going to fix it. And when they do, this thing is going to be worth 4 times what it's worth today because it's really been clobbered. And I was talking to one of my brokers who was the broker for Nicholas Applegate, where I went to work next. And she was a very high-end broker. She dealt with all the big momentum funds out of New York. She said, Emmy, you are crazy to be buying this piece of crap. Crazy. And I said, mark my words. 4 months from now, your momentum clients will be buying this stock from me at 4 times the price. And the funny thing was that when I joined Nicholas Applegate, I got to see the portfolio and it had Avid Technologies in it, so they actually had bought it.
That's so funny.
So that's my other principle is really, there's some balance between riding momentum of stocks, but also also don't discount, take a second look at those companies that have just been, forgotten, even Weight Watchers, right? With Ozempic recently, Weight Watchers just got absolutely clobbered. And then Sean Puri mentioned Weight Watchers on his podcast, and it went up 160% in a week. And so that's another, I don't know if Weight Watchers is a good investment or not, but that's another, kind of every dog has its day was a little bit balancing principle for me.
Well, to me, so, my personal net worth went way up and way down in my 20s, right? And then I decided I did want to get into value investing and just really went deep with Charlie and Warren and, Phil Fisher and Ben Graham and their, Howard Marks, Bruce Flatt, folks like this. And there are a number of similarities of where Warren Buffett says the number one trait to be a great investor is emotional control, or Charlie Munger thinks one of the most important things is thinking for yourself, and all these your friends are telling you you're crazy, like it requires self-confidence to not just be one of the sheep, right? And buy it at the peak when everyone else is already, when full consensus is, yep, this is a good idea. Now everybody agrees, to buy it.
If everybody's in, then who's the marginal buyer? Yeah, when I was interviewing at Nicholas Applegate, they asked me, they said, what makes a stock go up? And I said, more buyers than sellers. They're like, no, really? I'm like, really? That's it.
Yeah.
Now, what creates an environment where there's more buyers than sellers? That's a totally different question.
Yeah.
But that's really that's it. So it's interesting when you say like I have these value bents. I kind of went through. 30 years in the industry, you go through a lot of cycles and you go through a lot of learning. I think I was very blessed that I was so focused on horse riding in college that I did not have great grades. So I didn't get. I went to USC MBA, but I didn't go to Stanford or Harvard. And so then I didn't interview well at all. And so I took a real circuitous course into my first few jobs. And so my first job was just because I was researching for some people who work with Mike Milken, who at the time was a felon who had just gotten out of jail. And so my first job was working for him, and then I used that to get a job working in bonds. And so the first thing that I learned about, in terms of, aside from when I was managing my own money, which I'd done since I was 16, the first thing I learned about institutional money management was kick the tires first, because that's what you do in bonds, right? Is this thing going to pay? That's all you care about. Is this thing going to pay? And so even when I became an aggressive growth investor, the most money I made, I ran the number one fund in the world, and in the first 12 months of the fund, it was up 630%. It was up 495% in 1999. But the thing that saved me time and time again was combining kicking the tires and avoiding all of the pitfalls, avoiding all the drawdowns, and jumping in the stuff that are rocket chips. Right? And the problem is you got the rocket ship investors and you got the tire kicking investors, and they're not the same. But if you can kick the tires and make sure nothing's going to go wrong and the thing can go up 5x, then you're really making a lot of money.
Yeah. So at the time, how big was that fund?
That fund started with $4 million seed from the owner, Art Nicholas, who made $24 million in the first year off that one investment. And then by the time I left, it was about a $500 million fund.
Incredible. How big was Oppenheimer at the time you were managing the $6 billion?
It was $220 billion.
Yeah. That's
and
fascinating.
Now it's part of Invesco. Sorry. Now it's part of Invesco.
Yeah.
Oppenheimer got, yeah.
I feel like we can do a whole episode on this. I am fascinated. We might ask a few more questions, but I want to talk about MegaWealth. We talk about your 3 Bs.
Yeah. And I'm going to take this back to we've talked a lot about my investing success, but that does not equal career success. I was making a lot of money for a lot of other people and not making it for myself. And so that is why I wrote MegaWealth. Because the 3 Bs is breaking in, building equity, and breaking out. And the biggest shift in there that I believe people really need to make is to get into building equity as soon as possible. And the mistake that I made was, okay, so I've broken into investment management, right? I worked at Farmers Insurance, had a 3-year track record, and then Nicholas Applegate gave me the opportunity to manage my own fund. Out of that, and then I went to a real top hedge fund. So either after managing my own fund or working, even better, working at this top hedge fund for 3.5 years, I should have launched my own fund, period. Or been at a big fund company like Citadel and been given equity. And yet I waited and, I just thought, well, I really like to be an analyst because I like the work that I do as an analyst. And when you're a portfolio manager, you've got to do a bunch of marketing, you got to do all this stuff. that I didn't, and sales, I really don't. Well, frankly, if I'm trying to convince a portfolio manager to buy or sell some stock, I'm in sales all day long. So, like, I like sales. Let's be real. I just told myself I didn't like sales. But I was costing myself for the same amount of work, like 90%. I could have been making 10x or more what I was making. My bosses in a year where I would make 300,000, my boss would be making 100 million, 200 million, 400 million. I mean, it's just like multiples upon multiples. And they're doing the same work. That's the thing. It's not like they're different or they're special. They're just being paid in equity and I'm being paid in a salary. That's it.
Can we talk about that? Because, we talked about it before the show. I was on an M&A team at Citi, kind of. I was on the front end. My job was to call. So I was on mid-market, so 500 million a year and under companies. And because of my little bit of entrepreneurial experience, they thought I'd be good at talking CEOs into saying, owners into like, hey, what do you think about selling the company? A lot of businesses that side are still family owned and stuff like this, right? And it was shocking to me, the lack of thinking sometimes. Like the CVS of Canada, or the Walgreens of Canada, is called Shoppers Drug Mart, okay? 80% of the Canadian population lives within 20 minutes of a Shoppers Drug Mart, okay? And as I'm going through these people, I find out that for the first time in history, Shoppers Drug Mart location owners are allowed to sell. And they had been prohibited from by the franchise for 40 years or something, right? It's like, talk about the most amazing roll-up opportunity ever. I mean, they are like the dominant name. 80% of the entire country's population lives within, a short drive of them. This is, all of these owners for the first time in history are now able to sell. I mean, talk about pent up
incredible
interest, right? So I went and presented it to the bosses. They're like, we didn't ask you to do that. Go back and call who we told you to. Nobody did anything. And just the lack of entrepreneurial opportunity spotting was just mind blowing to me. I was 24. I was like, I could do this myself, people. What do you mean? We are Citi, And it's funny, they shut that division down after 28 years, and we're moving everybody to San Francisco, or we're trying to talk me into going to Smith Barney. I was like, no way. This paint by number stuff is I can't live within those limitations. And it's funny because I've had the big ups and downs since then, but I don't regret it. As opposed to staying in the cubicle and doing what you're told and not having any equity, right? Because some of these businesses, anyways, I won't even go into it, but we would often talk them into just selling a portion of the company to private equity, and they get the second bite of the apple. Getting the second bite of the apple after PE has grown it by a multiple, right? And I was like, I am on the wrong side of this phone. I want to be on the fund, I want to be the private equity fund hiring us. What am I doing? I'm on the wrong end of the phone.
Yeah.
And so I started my first fund at 27. And anyways, I'm drinking from the Kool-Aid here.
No, it's so true, because when you've broken in and you're comfortable. You're comfortable. I was comfortable doing what I was doing.
I'll just back up. Again, I was so young, right? A year earlier, I'd been selling ads for the Yellow Pages for $17,000 a year. My income went up 6 times, 6x in 1 year because of what I was making at Citi. So you're right. For us, that was super comfortable, going from 17 grand a year to making 120 grand a year in 1 year, right?
Yeah. And yet I call that the broke upper class. Because you're kind of you're making a lot, but you're a little bit miserable, and so you spend more because you're a little bit miserable, and you get your spending is close to what you're earning, but you don't have any breakout wealth opportunities because you don't have any equity, and that's I was in this so that's really the thing, that it took me 15 years to and there's also optimal times in the cycle to start building equity, aside from the cycle of your
Yeah.
career, the cycle of markets.
I probably should have stayed for like another few years until I was making 300 grand a year and knew more instead of like going out as a 27-year-old and having my big ups and downs. And, I was probably a little premature on my going out, but in the long run, hopefully it worked out. But go ahead.
Yeah, no. And so what, one of the things is like, it would have been optimal that when I stopped working at the hedge fund, it was 2003. At that time, all of the internet stocks like Amazon, Google wasn't public yet. They came public in like '07 or something like that, '06. But all of the other Yahoo, Amazon, etc., were trading at less than the cash on their balance sheet. The entire value of the company was the cash on the balance sheet. That was my opportunity. Like if I had to do it again, the hedge fund shut down. So I left the hedge fund because it shut down. He just made enough money and was done. But that was spring of '03. Summer of '03 is when all the stocks bottomed. I could have, you basically used the internet to move over. And the neat thing is with these new technologies, AI today, blockchain in 2016, 17, and internet in the early 2000s, there's nobody with experience. There's no one with more experience than you because it's a brand new technology. So it is the like in terms of market cycles, that's the optimal time to make a move. And so that's when I should have made a move. But even to listeners today, you think about what you're talking about, being 27, did I have enough experience? Should I have waited 2 more years? Most of the time I advise my mentees and also my clients to take 2 or 3 years breaking into the industry on average. It depends on the person, and then start building equity. So figure out what you want to break into and then start building equity. So I kind of 2 to 3 years, and then you've got to start building equity. But there's also like, watch these big cycles, because at the beginning of any of those cycles, we're all on the same page. Nobody has any more experience than anyone else. And so you can really jump in at a high level pretty quickly.
Yeah, no kidding. In our world, I mean, how much do I wish we had started our real estate fund in like '09, 2010, 2011? I mean, it's just incredible, right? I mean, right now we're like zero. We're trying to take like zero debt on any of our long-term holdings because I don't know. I feel like COVID wasn't a real recession. I feel like we've just had asset prices climb for 15 years, and up like an escalator, down like an elevator. Like, I really want to be like the only one unlevered at the point when everybody else is having a fire sale, and possibly have the cash on hand, right?
Nice. I like it.
Well, let's talk more about this. Break in, build equity, break out.
So we talked first about that one of the hardest things to do. Once you break in, you start making a little more money. You feel more comfortable and more confident in your role and what you do. Hopefully you like what you do. Like I really loved what I was doing being an analyst. And you can get stuck in breaking in for the rest of your career and never build equity. So that first jump is you got to be in there 3 years, 4 years, 2 years, something like that. Break into somewhere where you've built certain achievements that you can point to, and so someone is going to pay you a fair share of equity to join their firm. So that's number one. And then you say, well, Emmy, then what's breaking? I mean, building equity sounds like the whole thing. Like, and you look at someone like Bill Gurley, who's worth $7 billion, and he did exactly that. He was an engineer for Compaq. Then he worked on Wall Street and he worked as a computer analyst, right, on Wall Street, telling them what computer companies to buy. And Deutsche Bank offered him a position, and that they wanted to kind of really make a big statement. This is '99 when everyone wanted to make a big statement. And so they wanted more of a U.S. presence, and he was institutional ranked #1 analyst. And he said, the only way I'm coming over is if you give me the internet analyst job. And they said, okay, even though he didn't have a background in the internet, but nobody did, right? And they said, okay. He took Amazon, he took Amazon public in the IPO, And that had him then rebranded, even though his entire career was in computers. That had him rebranded as the internet guy, and then he obviously became a partner at Benchmark, invested in Uber and a bunch of others, but Uber was the big one, and is worth $7 billion today. So he did the whole thing just from moving from breaking in, and he broke in and then he moved himself over to internet and then building equity, right? So he took a little more time to break in so that he was in the spot he wanted to be in before he built equity. Breaking out is a more strategic and systematic way to make sure that every minute of your time you're making the most money possible for it. And it's what I call, and so what I say is breaking out is when your money flywheel is fully activated. Your money flywheel is a combination of build, invest, and advise. And so the best place, I mean, you look at where all the richest people come from, is private markets. And, that's Bill Gates, that's Elon Musk, right? Private markets. And they're private market founders. So that's build. But not everybody is going to be Bill Gates or Elon Musk or Mark Andreessen, right? Where we can't count on that. But what happens is if you pick a great company that you think the equity is going to go up in, and you get equity and you start building, maybe you do that in sales, and you help grow those sales from 10 million to 50 million. Other companies are going to want you on their board of advisors or board of directors later to show them how to similarly grow their company from 10 million to 50 million. And then when you're on a board of advisors and you're also talking to the VCs that have invested in the company that you're building, they may turn you on to some interesting investments. And so now you have investments in that same space. And so what I really recommend is that all of this happens at the same age of company. So maybe you want to be early stage. So you're investing in seed and Series A. You're building at companies that are maybe Series A to B, and you're advising companies that are probably seed or Series A. And then all of those roles give you ideas and opportunities for the other roles. And so then you create a flywheel of money that is the engine of your career. And so that when that is all working, when that's fully activated, that's what I call breaking out.
I love it. I have a couple ideas that I think relate, and I want you to tell me if you disagree. Okay. I love that billionaire Richard Koch, who wrote the book, The 80-20 Principle, about these small things that's like the hinge the whole door swings on. And he'd worked for BCG, and he's like, the guy who ran BCG did not work hard. Bruce, what's his name? He just invented a system where the rest of us worked 80-hour weeks. And then he switched over to Bain. And he's like, Bill Bain would be in the office constantly, just immaculately dressed in tennis gear on his way to a tennis game. Bill Bain couldn't even do the analyst work of the people he hired. But he created this system, and he got 80%. He got 80% of the profits of the rest of us killing ourselves. But he had thought up a better mousetrap of partnering with the CEO, and it was just like this thing. He's like, I couldn't unsee this. He'd been working at Shell after his MBA kind of a thing. He's like, wow, this is so different than your dollars for money. So he quit and started LEK Consulting and built it up with some partners. I want to say he sold his share for like $5 million. And then with kind of this 80-20 principle of investing, grew that to, I think, 1.6 billion, working, I think 3 hours a day in the early years and then later an hour a day, by just hyper focusing on how can the money multiply like crazy without any of my hours. Like you're saying, the screenwriter who makes the movie that makes 700 million, or, obviously there's more involved in that
leverage.
Story. But extreme levels of leverage, and just thinking harder, not just working harder, I think about those principles. And then I think about the picking your sport. this is what I kind of love about the way you've cycled this, is not saying follow your passion. What if my passion is badminton? Like, do we know any pro badminton players that are billionaires? I've never heard of one, right? But basketball, the Michael Jordans of the world, right? They picked a sport where these type of outcomes become possible, right? And you look at, as you're talking about, hedge funds and private equity, or there's places in entertainment, things like that. It is. I do feel like as a kid, they were always asking me, what did I want to do? I was like, oh, I want to be a pro snowboarder. That's what I want to do, right? If they would have said, like, what result are you looking for? And I told them all the stuff I wanted, they'd be like, oh, well, you need to become Bill Gates, right? And nobody would have, I went to a fine art high school. I went to college for illustration. I only luckily got headhunted into investment banking because of my sales and entrepreneur background, right? But anyways, I'm just fully endorsing this, like, not just some leverage, like intense pushing on the leverage, and then also picking a sport where the outcomes you're looking for are actually reasonable for that career. I don't know. Any reactions to all that?
Yeah. Yeah. So I used to really believe in the 80-20 rule.
Okay.
Until I read Gary Keller's book, The One Thing.
Okay.
And he asks, what is the one, and I think this pushes on the leverage even more. What is the one thing that you could do that would make everything else on your list unnecessary or easier? And I really believe you can only have one priority. And I think the 80-20 gets too many things in the priority bucket. It's a little murky.
Okay. I am so with you. I love that book so much. I had his co-author on the podcast, Jay Papson. And to me, they're not in conflict. What the one thing is it's the 80-20, the 80-20 of the 80-20 of the 80-20 of the 80-20 till you get to what is that one domino that will make everything else easier or relevant. And that's what I mean about, like, not just leverage, not just 80-20, but like extreme 80-20, where you have gone so far down to the one thing. So statistically, when you go 4 times deep, it's less than 1% that will create over 55% of the results, right? So if you did that 3 times, now you're 150% results. Potentially with 4% of what you're using your time on now, you could double your results. Like that type of like extreme leverage. Anyways, such a Gary Keller fan.
And then I would just push back and say people spend then too much time strategizing and planning, figuring out what the 20% of the 20% of the 20%. And quite often they already know the answer. They're just procrastinating, and they know what the one thing is already.
That's great.
So do the one thing.
Yeah.
And then the other thing about your following your passions is, when you get really good at something, you get really passionate about it. And there's a book called So Good They Can't Ignore You.
Cal Newport.
Yep, and they did studies about, like, what are people passionate about? You know what they're passionate about? They're passionate about veganism and yoga and travel, right? And he followed these people that kind of like became a travel yoga person or whatever, right? And you follow them for 10 years and they still have money problems. And you follow the other people that just found something that they're good at. And you enjoy things that you're good at because it makes you feel better, makes you feel more confident. And then you just keep doing it. And that's kind of what, and then it becomes your passion. And so, like, how does anyone get passionate about investing in stocks? For me, I started, when I was 16, my dad said, you're 16, you can have a stock account. It's time to start investing in stocks. I was like, oh, okay. I was just riding horses, minding my own business. Apparently I need to be a stock investor. And so he said, hey, here's like 4 stocks and I'll give you the story and you pick one and then we'll invest it for you. So I said, all right. So he gives me 4. One of them was a friend of his one of them was United Artists Cinema Theaters, and they just started putting food. Before that, they only served popcorn, and they started serving candy and various other things. So the idea is margins are going to go up. Well, that happened, and it happened so fast that another theater chain bought them out, or somebody else bought them out. And so I made 4 times on my money in like 4 months. So it's like, well, that was easy.
You caught the bug.
So my 1,800, is like 7,500 or something like that. So then my dad gives me a couple of other stocks, right? And so we look at them, and one of them was a friend of his, and he said, he has this healthcare, this real small kind of like healthcare group or whatever, but they figured out how to process Medicare claims in a profitable way, which nobody had figured out how to do. A tiny, tiny little company called FHP. And so I invested in that. And of course, FHP is huge today, right? But I didn't take it for the whole ride. But I made about, 4.5 times on my money. So now I'm sitting on like $32,000, right? Now, I do not recommend investing all of your money in one thing over and over. But, I'm like at the time, now I'm like 17, I have $32,000. And so my dad gives me, 4 choices. And he said, one of these, it was, and there's a theme here, because each time, which I use in private markets investing, the one I wanted to invest in was because not only was it good investment, but my dad knew the people and knew they were smart and knew they were going to do the right thing, right? And so he had a friend, he was on the board of directors with a friend, and that friend's son was at this little tiny company, little software company, that was the first one to figure out how to get computers, this is how old I am, get computers to talk to each other. And it was called Novell. And so I put $32,000, 100%. Don't do that. But I put 100% of the money in that, and it went up 10x. So I'm a sophomore in college with like $320,000 in the stock market. I was like, this is really fun. And I'm like good at this, like at picking from one of the 4 things my dad gives me. And then I, of course, had my downs. My mother passed away, and my dad invested everything in biotech, and literally all of that money plus the inheritance from my mother went to less than zero, and all I had left was a horse. And so I sold the horse, went to the broker, the head of the brokerage firm, which luckily was a fraternity brother of my dad's. And I said, look, I know that they don't normally allow, that like you as a brokerage firm don't allow me to trade on margin, more than 30% margin. And I have a 30% debt with you because, we couldn't sell fast enough. The biotech company that my dad invested in went down so fast, and that we couldn't sell fast enough to pay off the debts on the way down. It was just it was a market crash. And so all I had was I had $30,000 in cash from selling the horse and $30,000 in debt. So I said, can I run this at 50-50 margin, which the exchange allows, but your brokerage doesn't? And he said, yes. But I mean, like to him, he's living in an $80 million home. So, $30,000 to him was like, whatever, I'll let my friend's daughter try this out. So I was, again, very luckily, this was the end of the recession, because the biotech crash happened in 91. Now it's 92, and I'm at school. I've got a Bloomberg terminal, and I start trading all of these like small software gaming companies because I was analyzing them and figuring out that their earnings were changing more from an accounting perspective, but it was going to create all these big upsides in earnings people weren't expecting. So I was studying that in my accounting class, trading these stocks. I took the 60,000, turned it into 120,000 in 6 months, sold off the 30, and so I ended up with 90,000 cash or whatever at the end. And my girlfriend there at school was like, people would pay you to do that. And that was literally the first that I ever thought about doing that professionally. So I'm literally 25 years old, and I hadn't even had a thought about it, which is another reason I get so passionate about helping people strategize their careers, because most people were exactly like me. They're just kind of like a bumper car, a blind bumper car, and they're going to the next job or the next thing or the next opportunity. And pretty soon, you're 40 years old and you haven't, you don't have a plan. So that's what I love doing and why I love doing it.
Yeah. Well, listen, I know we're almost out of time, but do you understand you worked for 5 different billionaires? Is that right?
Yes. The first one was when I was very young, and so so a lot of times like that. Yes, that's true, and I mostly focus on the last 4.
Okay. What are some principles that you learned from your time working with them?
The biggest one is bet on yourself. And that is the biggest difference I see where people make a lot of money in their career or they don't make a lot of money in their career is the ability and to have the kahunas to bet on yourself. So that's number one. Number two is don't be afraid to focus. They all, like whatever it was they were doing, Mike Milken in junk bonds or the crypto guy that I worked with in crypto, they found a hole, they found a problem, they focused. And what that allows you to do is you get really good at one thing, Gary Keller, and then you compound. And people underestimate the benefit of compounding in terms of financials, right? Which is like compound interest and how much money you can end up with. And they underestimate compounding in their skills, in their career over time. There are so many benefits to compounding. And so that when I look at what the billionaires did that the rest of the world didn't do, they found a hole, they found something that they could really focus on, and then they kept the pedal to the metal on that one thing for a very long time.
It's funny when you say it that way, it sounds so simple, right? And yet, how many of us do something like that intentionally? Like, I know you're not like guaranteeing that will work, but like, how many of us are even trying that? Like, as a percentage, I look at my friends, very few of them are going like, here's my destination. I'm laser focused on that, and it is interesting as you say that. I really liked the way you said that first principle of betting on yourself. Can you dive into that a little more?
Yeah. And I also want to reflect on something that you just said really quickly, which is the moment that you know your destination, that you know you've mapped out your money flywheel and you're like, I want to be in Series B or Series E in this kind of industry. The moment that you know that, you come across as a completely different person. When I've had clients that have mapped this out and then they go back to the same job that they had or they're in a new job, they're already in a startup, but they hadn't mapped things out. They map things out and all of a sudden they start getting speaking opportunities. They start getting in front of the board of directors because people say they're a strategic thinker, and it literally happens overnight. So that's a huge benefit of mapping things out is like once it's in your head, it can't be unseen and you act like a different person. And then that dovetails right into betting on yourself, right? Okay, now you know your destination. You've got to believe in yourself, right? And like I talked about, the bulk of my experience, the last 8 years or so has been in startups, but before that, it's managing money. And it's believing in my system starts with believing myself. Have I done enough reps? Have I seen this pattern enough? And have I seen it enough that when everything looks like, the market is entirely against me, can I stand and know that I've seen enough, I've done enough reps, I've seen this enough times, it's going to turn out exactly how it did all the other 100 times, I've got to make this bet. And that's the exact same thing. How many times have you seen yourself do a great job? How many times have you seen yourself rise to the occasion? And then once you have enough reps, i.e. you've broken in, it's time to bet on yourself.
I love that so much. I mean, this is like a personal coaching session for me, so thank you. Where can people buy the books?
They can find it on Amazon. You just type in Mega Wealth.
Okay. Is there an audiobook? I haven't checked.
There's audiobook for Mega Wealth and Mega Wealth Careers. Mega Wealth Investing has so many charts in it that there's no way to make an appropriate audiobook, especially because with Amazon, with WhisperSync, they want it to be 97% the same as Kindle. And so there was no way to do it that I could think of. And so, just those two. Mega Wealth Careers have audiobooks.
Okay, great. I want to go back to this idea of destination. It's like a little more a little more woo-woo than my regular thing, okay? But there's this great quote of Will Smith from like, I don't know, 15 years ago or something, where he said like, when you don't know what you're doing and you're trying to push ahead, I think he's mostly talking about his entertainment career, but if he was applying it to the rest of anybody's life. He said, it feels like you're always like bumping into rocks and the river's sweeping you downstream and there's all these things that are in your way all the time when you're just trying to like take the next step, but you don't have this clear destination. And he's like, when you get like laser focused on just like a commitment of where you're going, he said, it's like the universe starts to part out of your path. And he's like, it's not like you don't fall down. It's not like you don't have these troubles, but he's like, all of a sudden, like a lot of obstacles like unobstacle themselves. Because when you know where you're going, hardly anybody knows where they're really going. Hardly anybody has this like rock solid commitment. Like somebody said, and this is like a decade before the Chris Rock slap, okay? But they said something like, what if you got kicked out of Hollywood? And he said, oh, well, one of two things would happen. I will get back in or I will die. And, and he just says it with such conviction that you're like, oh, I kind of believe that guy, you know?
Yeah, yeah.
And so it is funny post Chris Rock slap that he has come back and he's, you know, he's not where he was yet, but like that guy is not out of Hollywood. You know what I mean?
Yeah, yeah, yeah. And so that brings up an interesting thing, goals versus milestones, because when we go back to the conversation we had about compounding and people underestimating what they can achieve in the long run. So you set a destination, but I recommend that you set a moonshot destination, not a tiny destination. Like, and if you look at anyone over time, they set their destinations too little. And I have examples in my book of Anke van Groesven, who was a top international dressage rider. And her goal was to get a gold medal at the Olympics. And no one from Holland had ever done that. Germany had won the Olympics individual and team medal for 52 years. Like nobody else, right? So it looked like a great goal. So she won 2 Olympic golds in 2 consecutive Olympics. And when I met her, she was just like sitting up in a room, totally dark, completely depressed, 2 weeks after winning an Olympic gold the second time, because she had no more goals. And it's so hard to get like re-energized. And so what I recommend is that you have these moonshot goals. When you set that destination, set it big, set it high, set it bigger than you could ever think. And then have milestones along the way to build your confidence, to say, hey, I'm making progress. But I do not believe in reasonable goals.
And then tell me about the milestones piece.
So I set up, actually, when I set up a plan for someone, I set up kind of what are we doing in the next 4 quarters to move towards this destination, and then the next 2 years, the next 5 years, and then what my clients tell me is so differentiated in what I do. The next, where are you and what are you doing 10 years from now and 20 years from now? And that's a big plan. But what happens is these milestones look like what are you doing every day on your LinkedIn presence? On the milestones, I say, you start getting invited to do public speaking, and you start getting asked on advisory boards. And by this time, you will be on X number or between 2 and 4 advisory boards, and you will have made these investments, right? These are the small things that say I'm getting towards my goal. And then, and I get these little texts from my clients like, woo, I got invited to an advisory board, right? That's a milestone to celebrate. That is not a goal, right? I mean, the goal has got to be some big moonshot goal, like I am going to be US president, or I am going to found my own. Oh, don't laugh. Like that. These are the types of goals, right? I'm going to found my own private equity company, or I'm going to build a multi-billion-dollar startup.
I love it. Well, while we've been talking, I just bought Mega Wealth, so I got to start. I got to start this later today. This has been so fun. Thank you for making the time.
Thank you very much for having me. It was a pleasure.
You bet. Okay, bye everyone.